In today's video, I want to take us through some math, okay? And I'm not talking about our boring high school math, all right? I'm going to take us through some market math, and we're going to talk about the math of declines. And hopefully, what we can get from this is we can pick up some tools on how to make us a better investor. So let's talk about the different types of markets that there are, okay? So we know markets go up, we know they go down, and occasionally, they trade sideways, right? Those are what we know as the three different market directions. But let's take a look at that a little bit deeper and look at what, from a graphical standpoint, we have a rising market, okay, and then I'll use the red, and I'll explain why in a second, for the declining part. Now, when we're coming up here, we're not creating new wealth, we're actually just recovering from this loss, and maybe we've got some sideways action too. But it's up till when we get to this point, okay, which is from here, okay, this is the area where we're creating new wealth again, okay, so here, and this part is declining or recovering from that loss. Now, the reason I bring this up is if we look at this, okay, this area that's in red, statistics and research has showed, we spend almost 80% of our time in this space. It's kind of hard to imagine, right? Especially with markets the way they've been. Even though they're hitting new high, they're spending a lot of time either declining or just moving sideways as opposed to creating new wealth, which is about, 20% of the time. Okay, so if we're going to spend so much time in here, let's talk about what it means, what these declines mean for you in the portfolio. All right, so I'll come over here. I tell you what, we're going to go through the math of losses and the amount of break even. So we're going to outline and define these declines, and I think you might find it interesting. So let's just say this decline here was a 10% decline. Okay? Now, if you want to have some fun, next time you go to a restaurant, okay, and ask your friends, I've got a portfolio, it's down 10%. How much do I need to get back even? You'll be surprised at how many people say, well, you're down 10%, you need to go up 10% to get back even. Is that the case? No, that is not the case. In fact, to get back to even, you need 11%, okay? So this is the loss, and this is the gain that's needed to break even, right? Okay. So, this isn't the end of the world. In fact, this happens all the time. If you're trading something like Bitcoin, this probably happens every minute, okay? But as far as markets and indexes go and things like that, these are common, and a 10% decline, it's not insurmountable to make 11% to get back to even. Let's stretch it out a little bit. Let's just say we take the definition of a bear market, which is down 20%, okay? If we have 20%, the gain that's required to get back even is actually 25. Okay, again, not unheard of. In fact, when this video was being shot last year, the market was up pretty close to that, a little less. But so we take a correction. 10% decline is known as a correction. 20% is known as a bear market. That's just a little jargon for you. But we look at these two. These two things happen, quite frequently, 20 less so than 10. But what if we extend this out a little bit and we look at a 50% decline, okay, or even let's just say a 75% decline? What's the gain that's going to be needed on this? All right, so we go back to our original example. You had $100, it's down 50%, you now have $50. Well, the math's pretty easy on that one. It needs to double. You need 100% gain to recover from that loss, okay? And 75%, this is even crazier, 300%, okay? So we really want to avoid these, large type losses. Now, we did another video before on drawdown where we talk about, how to calculate, how to look at your investments and look at what the drawdown is on them, which is essentially outlining, what these numbers look like for the individual positions that you have. Okay, but Since 2000, we've had 2 declines like this in the S&P 500 of 50%. That took 100% to get back even, and it did that, okay? But on top of just the gains that's needed to recover, let's talk about how long it's taken those gains. So we ran some numbers back to 1900 when they started tracking this data. There have been the average decline. Now, when I say decline, any decline over 20%, okay? So the average bear market or decline over 20%, its average decline has been 33%, all right? And the time it's taken to decline has been about 332 days. So on this chart I drew up here, that means that this decline here on average has been about 33%, anytime it's been more than 20. And the time it's taken to do this has been about 332 days. So let's just call it a year, roughly, all right? So we know that time. Now, how long does it take us to get back to here, to get back to break even? And the answer is 2.1 years. Okay. So again, not the end of the world. A lot of us have investment time horizons of over 2 years. So let's rewind the clock a year to the last bear market we had, and that was February 2020. The S&P 500, the stock market, from February 19th, I think was the date, to the low, that was down, if I remember correctly, about 34%. Okay, so I'll just put it up here. The Corona bear down 34%. But here's the interesting thing. Now that kind of lines up with this, but it did it in 33 days. I'm starting to see a trend here with the number 3, but that was fast. That was a big decline, and that was fast. How long did it take till it got back to break even? 6 months. Okay, so if this was the only bear market since you started investing that you've been in, you're probably like, I just go on vacation. I'll come back and we'll be good. Okay, sometimes it's a little bit longer, and in some cases it's been even longer than that, but we can kind of compare the averages. Now what I want to do here now is I want to take you through a couple of things that you can do when you're faced with the math that declines like this. Okay, the first thing that you can do is what we call dollar cost average. Okay, this is where you're adding more money into your account, which when these declines happen, you're essentially buying more shares at a cheaper price, okay? This is pretty typical in your 401k that you're doing, and it works well. Declining markets actually help you in that scenario. The second thing is to increase your emergency funds, okay? So if this happens and some unforeseen expense comes up, then you don't have to dip into your investments. You've got enough cushion there. So adding a little bit more money to that emergency fund makes some sense and helps you weather these, average numbers here, average declines, average duration. The last one is to lower your risk. Maybe you've been riding the bull market for the last 10 years since 2009 or 11 years now, and you've got tremendous amount of gains. That's a good thing. But maybe it's time to look at the portfolio and see if there's some areas to reduce some risk. That's another option. And then the last is to just hold through it, ignore all the other things, and just let the market do its thing and come back, okay? That's also another option. With hold, though, there's 2 caveats, okay? The first one is emotion. Now, there aren't a lot of people out on the ledge at 10%, okay? You get 50 or 75%, even the most experienced investors are getting nervous, and they're starting to run calculations in their head about what could change in their life because of this decline. So assuming that your emotion or your behavior at this point is going to be rational is, in a way, a bit of a stretch, and it might not be realistic. The other thing is you might have an unforeseen expense, okay? This might be something that you didn't see happening, which happened above what you had in emergency funds, okay? And that expense, you're forced to take it out down here, okay? So that's just one of the risks of just holding through those. But the combination of all those things, or using some of them, are ways that you can mitigate the math of these declines so that you don't need as big a gain to get back to even. So I hope this was helpful. If you enjoyed this video, please hit the subscribe button, and it lets us know that to keep making these and keep them coming your way, and we'll see you in the next video.